the bull run has a ways to go, in my view. I think this secular bull run will probably peak out at around $6,000 an ounce. And the reason for that is
The Federal Reserve has started cutting interest rates, but quantitative tightening remains in effect. Inflation fears are rising as the labor market weakens, and gold keeps climbing higher and higher with no end in sight. Hello and welcome to Milk Road Macro, the podcast that knows that there is more to life than monetary phenomenons, but if you dump $6 trillion out of a helicopter, it's going to do a lot more than just stop traffic. I'm your host, John Gillen. Today is Tuesday, September 30th, and we are joined by one of the most impactful economists in history, Professor Steve Hanke. Professor Hanke teaches applied economics at Johns Hopkins University, where he also founded and co-directs the Institute for Applied Economics, Global Health, and the Study of Business Enterprise. He has spent decades advising world leaders and is known for his expertise in international economics, currency stability, and hyperinflation measurement. In the next 40 minutes, Professor Hanke is going to explain how to fix the U.S. economy. So if that sounds good to you, make sure you like and subscribe. Share this episode with somebody who's going to enjoy it. And as a reminder, our Milk Road Macro research team lives and breathes macro. Every month, we drop a report, a pro report that explains what's going on in macro, breaks it all down so you can understand it. Our next report is due out in a couple of days. I read a draft. It's really an incredible amount of research that's in this. It's going to help you a lot if you're an investor. So if you want to get in on that alpha, get everything you need to know about macro going into Q4, join our pro community today so you don't miss out on that. The link is below in the show notes. And without further ado, welcome to Milk Road Macro. Professor Hanke, how are you, sir?
great, John. Great to be with you.
I'm very happy to have you. You, as we were talking about before we started recording, are one of the most influential economists in the world. And so I wanted to start with a question about your thoughts on where we are in the Federal Reserve's monetary policy path. A lot of analysts have been very focused on interest rates and how the Federal Reserve has started to cut those. You have been calling for the Fed to end quantitative tightening, though, and pivot to quantitative easing. But they have not yet done this. Explain to our audience what exactly quantitative tightening is and why you think they should end this policy. And what's your thoughts around that?
Okay, the first thing to realize, John, is that monetary policy is not about interest rates. It's about changes in the money supply. And so you have to look at things that directly affect the growth rate and the money supply. And the reason for that is that it is the fuel for the economy, the money supply, the stock of money, the liquidity that we have. So the broad measure of the money supply in the United States is put out by the Federal Reserve is what's called M2. Now, if you go to the Center for Financial Stability in New York, they have broader measures, more inclusive, and I think better measures. They go up to M4. But at any rate, be that as it may, you've got to measure broad money, whether it's the Fed's M2 measure or the Center for Financial Stability M4, and watch the growth rate in that money supply, because that will determine the course of nominal GDP. You're talking about macroeconomics on the program. Well, nominal GDP is the nominal value of final goods and services in the economy, and it has two components. The inflation is one, and the other is whatever the real rate of growth is. So you add those two things together, the inflation rate and real rate of growth, and you get a nominal GDP number. And to get that, you've got to know what's going on with the money supply, not today, but what was going on with the money supply a year ago or 2 years ago, because there are long lags between the changes in the money supply and actually changes in nominal GDP and in particular in inflation. Inflation is the most variable part of the nominal GDP. So what about quantitative tightening? Back to your question. What we have had for some time now, since really 2022, is a tight monetary policy. And what I mean by that is that the money supply has been growing at below Hanke's golden growth rate, a rate consistent with hitting the inflation target of 2%. And right now we've got the money supply. It was contracting between April 2022 and this summer. It actually was in a contraction phase. We've only had 4 contractions in the money supply since the Fed was founded in 1913. And all of those resulted eventually in recessions, or in one case, actually, the Great Depression, 1929 to 1933. So that's where we were going. And now the money supply had started to grow at a little bit more rapid rate. And the Hanke's golden growth rate is 6.3%. Let's just call it 6%. And it's growing now, M2, a little under 5%. So although its rate of growth has increased and the money supply is not contracting anymore as it was, we still have a tight monetary policy, and the best way to loosen that up is to terminate quantitative tightening. Everybody keeps talking about the interest rate, the Fed funds. What are they going to do in October? What are they going to do in December at the next FOMC meeting with the interest rate? And everyone, whether it's the White House that's criticizing the Fed, or whether it's Jerome Powell, chairman of the Fed, or whether it's a journalist, or whether it's every economist under the sun, they're all talking about the interest rate. Well, monetary policy is not about interest rates. It's about changes in the money supply. And what is a big factor is quantitative tightening. Now, you stated, John, that I thought they should get rid of quantitative tightening. That's true. But then you said, and go to quantitative easing. I didn't say that. They should let the money supply gradually go up to around 6%. It's headed in that direction now, but if they got rid of quantitative tightening, it would move a little bit more rapidly and hit
Gotcha.
Hanke's golden growth rate of about 6%. And then we want to keep that growth rate in the money supply constant. We don't want to be on a roller coaster, which we've been on with.
Right.
When you use interest rates, you're on a roller coaster with the money supply. It's up, down, up, down, up, down. And of course, what happens? Inflation goes up, goes down. The economy gets hot, and then it cools off. That's a roller coaster effect associated with focusing on the Fed funds rate. And by the way, the Fed explicitly rejects the quantity theory of money, and what I'm talking about, the focus on the money supply.
So, okay, there's a lot in that answer. I want to come back to this idea, this Hanke's golden growth rate, and kind of unpack a little bit more what that means for the audience. But just to sort of synthesize some of those ideas there, after the COVID crisis, we had this huge injection of money, this helicopter money of $6 trillion, like I mentioned in the intro. And then, like you said, since 2022, the monetary supply has been contracted and is only recently reaccelerated back to the highs. And I think that, just like you said, like a lot of people have been focused on interest rates. Your focus on the monetary supply, I think, has been a more, let's say, lucid look at what's actually going on, what the actual problem is. Unpack for us this idea of Hanke's golden growth rate. What goes into that, and why is that the target growth rate for monetary supply that we need to aim for in order to have this price stability and stable inflation? How did you arrive at that 6% number for growth rate of the monetary supply?
Let's just back of the envelope without getting out in the weeds too far, John. So
Great.
The quantity theory of money, by the way, I have a new book that was actually issued by Wiley in May, and I co-authored that with Matt Sakurki. It's called Making Money Work. And that book, one of the main arguments is that we have to get the quantity theory of money back into macroeconomics. And you know, you're running this macro program. Well, that is macroeconomics. Macroeconomics has two components: money and capital. Monetary theory and capital theory, that is macroeconomics. It turns out I've written another book about a year ago with Leland Yeager called Capital, Interest, and Weighting, and that's the capital theory part. And the thing with Sakurki, Making Money Work, this new book is monetary theory and the quantity theory of money. Now, Hanke's golden growth rate, how do you get that? Well, everybody can write down MV equals PY. M is a change in the money supply. V is the change in the velocity of money. P is the change in the price level, the CPI, and Y is the change in real economic activity or real growth. And if you plug the numbers in, what we want to do, we want to solve for M. So M equals P plus Y minus V, because you're taking V from the left-hand side of the little equation, the right-hand side.
We're getting pretty deep into the weeds here, but
But if you do a minus and a minus, it actually ends up being a plus. And the minus is velocity is actually negative, about 2%. So all these numbers are twos. We have the price level target is what? 2%. That's the inflation target. Y, the potential growth in the economy, it's a little over 2%. Let's just call it 2. And V is actually a minus 1.8. Well, let's call it minus 2. So if you do it in simple terms, and you don't have to get out in the weeds too far.
We're pretty deep in the weeds now, I think.
M equals P. P is 2. Plus Y is 2. Plus V is 2.
I'm a little bit lost, Professor, but basically the idea I was trying to get at was, why is 6% monetary growth the ideal to hit these targets?
Well, remember, 2 plus 2 plus 2 equals 6.
Okay.
That's not too far.
That's good. That's simple. Yes.
That's called the MV equals PY is what's called the equation of exchange. That's from the quantity theory of money. Now, we're using that equation of exchange, and we're solving for the growth rate in the money supply that would make us hit the 2% inflation target. And that's how you get it.
Okay.
So it's just a simple, algebraic thing. Of course, you have to have the right data to put in there and make some arguments about it. And I just did the quick back of the envelope thing. I'm sorry I took you out in the weeds a little bit too far.
Well, I think
anyway, you get here's the intuition of this 2 plus 2 plus 2 equals 6. It's a rate of growth, the rate at which you want the money supply growing to accommodate what? To accommodate hitting the price level of 2%, accommodate the real growth in the economy, fueling that real growth, and fueling the inverse of velocity actually is really the demand for money. So it also gives fuel and accommodates the demand for money. So the three things: it accommodates hitting an inflation target, accommodates real growth, and accommodates the demand for money, the increasing demand for money. If the velocity is -2, that means that if you do the inverse of that, you end up with a demand for money, and that's a +2.
Most Web3 projects launch a token first, and revenue, maybe later, maybe never. But KGeN flipped the script. $30.6 million in ARR before a token ever existed, thanks to VeriFi. Cash flow positive, growing month after month, and powering 31 million verified users across AI, gaming, and consumer apps. In a market full of hype and empty metrics, KGeN is proving that Web3 can be built on real revenue, real users, and sustainable growth. Want your protocol to scale with results that last? Grow with KGeN today at milkroad.com/KGeN. Yeah, because there needs to be demand for money as well in the economy. I want to kind of pivot now to something you spent a lot of your career on, which is inflation and dollarization. But I want to start with your work on hyperinflation, and just tell our audience a little bit about the difference between inflation and hyperinflation. You're one of the world's leading authorities on hyperinflation. You've done case studies on Zimbabwe and Venezuela. You worked on things like the Troubled Currencies Project. What is the difference between inflation, like normal inflation that you would have in an economy, versus hyperinflation? And when does a currency cross from normal inflation into hyperinflation territory?
Okay, so hyperinflation, the convention in the economics profession is to define a hyperinflation as an inflation rate of 50% per month or more. 50% per month or more. So that's a high inflation. And if you looked at hitting that 50% per month inflation rate for 12 months in a row, where would you end up? You'd end up with an annual inflation of 12,875%. So we're talking about huge numbers here.
Right.
I mean, they're the kind of thing no one has really experienced recently, unless you've been living in Venezuela or
Venezuela, yeah.
Zimbabwe,
Right.
obviously 2008. So it turned out that I think I can easily say I am the world's authority on hyperinflation now. Every hyperinflation in the world, I've gone back with the and looked at the original primary data and actually calculated what the hyperinflations are. And we've tracked down every hyperinflation that's ever existed in the world and recorded those in what's called the Hanke-Cruz hyperinflation table. And that was first, by the way, the first version of that was in the Routledge Handbook of Major Economic Events in History. And that table ends up, Nick Cruz and I did this, one of my former students. So the highest hyperinflation, just to give you an idea of what's going on, is in Hungary, and it peaked out in July of 1946, and the daily inflation rate was 207%. The daily inflation rate was 207%. That meant that the prices were doubling every 15 hours. Then
Wow.
Zimbabwe, I measured that. I was the original one that did that with Alex Kwok. That peaked out in mid-November 2008, and the daily inflation 98%. It was down. Remember, Hungary's number 7% per day. Zimbabwe was 98% per day. Every 24.7 hours, prices were doubling. Then Yugoslavia is fairly recent, January of 1994.
Well, Professor, I think we've got a good sense of this for history. I think I'd like to try to bring this to the modern day, though, because the Federal Reserve has been trying to control inflation in this country. They've been struggling to get back to their 2% target, but they haven't been able to get there. And it seems like they're starting to admit that maybe they never will. If the Federal Reserve asked for your advice on how to combat inflation today, what would you tell them?
2 plus 2 plus 2 equals 6%. Keep the money supply growing at 6%. As we were doing in the 1990s, it was growing a little less than 6%, by the way. And what was the inflation in that period? It was a little less than 2%. So the proof of the pudding is in the eating. It's all in the quantity theory of money, John. If you follow the rules, you're going to get the results, and you're not going to get hyperinflation. By the way, the United States has never had a hyperinflation.
Right. Yeah, no, I know. And I think that we're trying to avoid that. But yeah, I think that...
John,
Sure.
let me ask myself a question.
Okay, ask yourself a question, Professor.
What's the highest inflation rate in the world today? Because I measure these inflation rates. I have a way of doing it the same way that I did it in Zimbabwe in 2008. I can measure these high inflation rates every day very accurately. And the highest inflation rate in the world is in Venezuela right now. And what is that rate? The rate is 564%, 0.7%. Let's just round it off at 565. That's the highest inflation rate in the world. That's the only country that's in triple digits, by the way.
Yeah.
The second highest, you have to go back. Iran is about 85%.
I wanted to ask about this. So, one of the tools that you've advised numerous world leaders on how to combat inflation, how to promote currency stability in their economies. And one of the tools you worked and wrote extensively about was dollarization, which you've helped nations like Ecuador, Montenegro adopt the dollar to help stabilize their economies. Recently, we saw the Genius Bill passed in the United States to promote the use of stablecoin dollars. And I'm curious your thoughts on how that might affect dollarization and the dollarization process globally. Do you think that this is going to encourage more either nations or individuals from other nations to adopt the dollar to protect their
Oh
capital and
yes,
have some currency stability?
there's no question about it. Now, what is dollarization? Dollarization is different than the stable coin. It's something related to it, but what it is you get rid of the local currency that's rotten, and you replace it with the U.S. dollar. Or in the case of Montenegro, when I did that in 1999, we got rid of the hyperinflating Yugoslav dinar, and we replaced that with the Deutschmark at the time. And of course, now the Deutschmark has been replaced by the euro. So in Montenegro, they don't have a local currency. They use the euro. In Ecuador, in 2000, we got rid of the sucre and replaced it with the US dollar. And so it's kind of a simple process. Now, the other process that I have used in Argentina, Estonia, Lithuania, Bulgaria, and Bosnia Herzegovina is what's called a currency board. And the
Yeah,
currency board does issue a local currency, and that local currency trades at a fixed exchange rate with an anchor currency, let's say the US dollar, for example. And it's backed, the local currency, 100% with US dollar or anchor currency reserves. So the local currency is really a clone of whatever the anchor happens to be. So
right.
now let's throw in stablecoin. We've got stablecoin. It's not produced by a government, but it is similar in principle to a currency board, in the sense that
Right.
now with the regulations that they have, supposedly, let's say you have a stable coin that's anchored with the US dollar. It does what? The stable coin trades at a fixed exchange rate with the US dollar. Okay, that's point number one. And point number two, it's supposedly backed with US dollar denominated assets, just like a currency board anchor would back up a locally
Right.
emitted currency. So let's get to the policy part of this. Right now, at the invitation of the Trump administration, I've been advising them on exactly this point. They're in favor of stable coins backed by
Right.
U.S. dollars,
Yes.
and one reason they're for that is that they think it will, and it will increase the demand for U.S. dollar denominated treasury assets, treasury bills. So that's one aspect. But the other aspect is that, well, just full dollarization. If you want to increase the demand for dollars by promoting stable coins that are backed by U.S. Treasury bills, why not just go full bore and dollarize? So what are we talking about now? We're talking about a blending, a kind of a two-shot approach. You're okay. Promote the dollar with stable coins, but why not just promote the dollar outright? And you've a lot of countries with lousy currencies that it would be very attractive, at least in principle, to replace those lousy currencies and their central banks with the greenback.
Right. Do you
Now,
think that that
country
is
not
going to be effective? Yeah. Go ahead.
of course it's always effective. There's never been a failure. There's never been a currency board that's ever failed, and there's never been a dollarization that's ever failed historically.
Right.
So again, the proof of the pudding is always in the, and forget the economic theorizing and all the BS you get from economists. Look at the historical record. You've got hundreds of these cases that have been done. And by the way, it doesn't necessarily have to be the US dollar. Liechtenstein does what? They're dollarized in a generic sense and they use the Swiss franc. Liechtenstein does not have its own currency. It uses the Swiss franc. So,
Right.
I think my sense is that we're going to see a lot more of this. And one of the prime candidates is, of course, Argentina. Now, 2 weeks ago, the peso got in trouble big time. And Scott Bessent, the U.S. Secretary of Treasury, said, well, I got a bazooka and we're going to bail them out. However, President Milei is a friend of President Trump. He's a good guy. He's doing all the right things, but he's got trouble with his currency. We're going to bail him out. Now, my suggestion would be Milei campaigned and won an election in 2023 based on his promise to dollarize Argentina and get rid of the peso. He wanted to mothball the central bank and peso and put them in a museum and adopt the greenback. He should have done that. I recommended that he do that. I've been recommending this, by the way, in Argentina ever since 1991, in writing, by the way. So it's not something happening behind a curtain that nobody knows about it. It's in writing. I was President Menem's advisor from 1989 to 1999, and I kept advocating dollarization. Well, finally, Milei ran on it. He won on it, but he hasn't done it. He should do it.
Well, I think it may be coming. So for those who don't know, the history of Argentina's monetary policy and their situation is quite fascinating. I did a case study on that when I was in school on economics myself. But I want to ask you about the long-term implications of this, right? Because what seems to be happening to me is that we're seeing a flight of capital towards safer assets in the capital markets and the currency markets. We're seeing this with central banks moving from the dollar and dollar debt to gold, but we're also seeing this with people moving from, as you're describing, weaker currencies that are more prone to hyperinflation and towards the dollar. What are some of the benefits and risks that are posed to the United States if we see more countries move towards dollarization, move towards adopting the dollar? What are the pros and cons of that? How do you think about that?
Well, first of all, let me make 2 points. The first point is capital flight. Now, let's go back to Argentina. I just did an analysis of Argentina, and from 1995 until the end of last year, capital flight in Argentina has equaled 68% of the mountain of debt that they've accumulated since 1995, which is $177 billion. So the money, people don't trust the peso. So the money comes in. They borrow money. And by the way, they're the world's biggest deadbeat is Argentina. So they borrow money. The money comes into Argentina, John, and in the front door, but 68% of it goes out the back door. So it never stays in Argentina. So that's the capital flight thing you were alluding to. And I've been making very precise calculations about capital flight in these various countries. It happens that capital flight's a big problem in Argentina. And it's related in simple terms to the fact that people don't trust the peso. They don't want to be in peso-denominated assets. So that's the first point I'd make. The second point is that if the dollar became even more of an international currency, that would be a good deal for the United States, because the capital does what? It doesn't fly out of the United States. It goes into the United States. So it makes it easier for what? It makes it easier for the Americans to finance their trade deficit and actually consume more than they produce. If you look
and
at
fund
spending,
our government.
Yeah, also funding the government.
Right.
But if you think about the trade deficit, which most people, including the president of the United States, have all screwed up, we have a trade deficit. Every year we have a trade deficit since 1974. Why do we have that? It's simple. The U.S. Americans spend more than they produce. Consumption plus investment plus government spending, that number exceeds GDP, and the amount by which it exceeds GDP is made up precisely by what? The trade balance being negative, a trade deficit. It's just
Right.
national income accounting. It's a simple identity. Americans cause the trade deficit to occur because they consume more and spend more than they produce. And the trade deficit makes that up. Now, where does the capital flow come in? The capital flow comes in, it's easy to finance because everybody wants to be in dollar denominated assets. So the capital flows in. We have a trade deficit, but there is
Right.
a capital inflow
Well,
financing
yeah.
that.
So this is, you're describing sort of the economic system that we've kind of shifted to with this system we've gone towards of becoming consumers and offshoring a lot of manufacturing and industry, and that's a whole big thing I don't think have time to get into right now. But what I want to like bring together for the audience so that they can understand is Professor Hanke's work. What he's talking about is that a failure of central banks to understand the impact of monetary supply on inflation and on the economy has led to situations where many countries and their economies have been victims of hyperinflation. And that has led to a situation where there's capital flight out of these countries and it's looking for a safer place to go. That, I think, is going to be the US dollar and gold. I wanted to use this as a way to kind of pivot away from thinking about capital flight into the dollar and also talk about what we're seeing with gold. Gold has been on a historic bull run this year and in general. You've predicted that the price of gold could rise up to $6,000 by the peak in this cycle. I would love to hear your thoughts on this huge demand we've seen for gold and how you arrived at this prediction of a $6,000 price target, and just kind of hear some of your thoughts about that.
Okay, so first of all, what's going on? We've got gold today at $3,864.50 as I'm speaking to you, John. On what did you say it was, the 30th of the month? 30.
It's Tuesday the 30th. Yes.
So it's got the bull run has a ways to go in my view. I think this secular bull run will probably peak out at around $6,000 an ounce, and the reason for that is just looking at the growth rate in disposable income in the major countries, major economies in the world, and looking at that growth rate and the relationship with gold, I arrive at that kind of peak figure. So,
okay.
So we got a ways to go. The bull is still running pretty strong, actually. And what's interesting, John, gold. Let's say gold has gone up, roughly 45% in dollar terms this year. But it's interesting, almost no one talks about it.
I think people are starting to notice. And one question I want to ask you about this, it's interesting that you referenced consumer disposable spending as your thoughts or your reasoning on this price target for gold. What I've been seeing, and something I'd like to hear your thoughts on, central banks for the first time in 30 years have now shifted to holding more gold on their balance sheets than dollar debt. And this is like a big sea change, I think, in the world of central banking. Do you think that this bull run in gold that we've seen is mostly driven by central banks buying gold, or do you think it's going to pivot out into more retail consumer spending going into gold as a safe haven asset, or is it both?
Well, it's both, but it's mainly the central banks and the central banks. And when you talk about private consumption, it's China. If you
Right.
if you look at commodity markets of any kind, whether it's precious metals or base metals or grain or virtually any commodity you want to name, China is the tail that wags the dog. So there has been a considerable amount of private of gold in China, but the central banks are the big kahuna, and the big reason for that, behind that, it's all related to this weaponizing of the dollar.
But do you want to explain a little bit more of that? Because I think that's I think that is true. The number one saving vehicle in China and India is gold, and Americans are not really of that mind. And so I think that we think about savings and about gold as an investment in completely different ways than they do over there.
Oh yeah, there's no question about it. You know, I'm a buy gold, wear diamonds kind of guy.
That's an all-time quote. So okay, well let me.
I'm not wearing any diamonds, by the way. I have a gold wedding ring. But
well, keep me updated on the jewelry situation.
I'm not one of those guys. I'm not one of those guys. But at any rate, the weaponization. Now, what is the weaponization? That's really what you asked. I shouldn't have used that word. It's kind of a jargon type thing. It's sanctions, financial sanctions against Russia, and impounding the Russian central bank assets, and limiting activity on the clearing system called SWIFT that's dollar denominated and so forth. That all of those things are weaponization. So there is a move, particularly among obviously the Russians and Chinese, to move away from the dollar. So that's
gotcha.
The sanctions are a stupid tool because they never work. They always backfire. They have all kinds of unintended consequences. And one unintended consequence is this: you
capital flight.
If you lighten up on the thing that's weaponized. So what are they doing in China? They're gradually reducing the stock of U.S. Treasury bonds that they hold at the central bank and replacing it with gold. And you got the same thing going on in Russia.
I want to end. We're coming up on time here, so I want to end with one more question. We talked about this bull run, which you said is going very strong, and some assets that are benefiting, economically speaking, monetarily speaking, being gold and the dollar. I just want to hear, you think that the bull run's still going strong. You think it's still going. What metric are you looking at to say whether or not you think the bull run is still going? And what are you looking for as an indicator that the bull run is over?
6,000. That's when it's going to be over.
And it's going to be over at $6,000 because.
Let's put it this way. Let's keep things very simple.
I love these answers. You give them very simple answers, but then you give very long ones where you get into algebra too. You're a very mixed bag of interview answers here. So why is the bull run going to be over when gold hits 6,000?
I think it's wise to keep you and your viewers on their toes and a little off balance. So
I'm very off balance. So mission accomplished.
Give them vanilla and then give them a little bit of a complicated assortment of flavors. So as someone who's been in the markets for a long time, and by the way, speaking of Argentina, I was the president of Toronto Trust Argentina in Buenos Aires. In 1995, that fund was the best performing emerging market mutual fund in the world. So actually, I was number one once, which isn't bad actually.
Okay, well, so back to the question though: why is $6,000 for gold going to be the top of the bull run?
I think it's going to be the top of the bull run because of the profile of what my projections are with regard to disposable income. I mean, that's the basis for the calculation. Now the number, if you're and if you're trading, by the way, usually I never give these endpoints. People always say, well, Hanke, where do you think corn's going? You know, and I say, I don't know where it's going, but I know now it's going down, and I'm short, and I'll stay short as long as it keeps going down, and I don't have a signal that it's going to be bottoming out or stalling out on me. So as someone who's trading, it's the delta, it's the change. Is the thing going up? And I don't care how far it's going to go. It's just I got to be convinced it's going up if I'm long, and if I'm short, I've got to be convinced that things going down. And I don't pay too much attention to these endpoints. The $6,000 thing, people kept asking me over and over about it. I refused to say anything about it, and then finally I did a little scratching around and figured out, okay, that's a good number. And by the way, using a completely different method of all kinds of disastrous scenarios and so forth, Goldman Sachs added all those up, and what did they come up with? 5,000.
Right. Yeah, which is why I was curious, because your target's higher. But I think what I'm hearing you say is that as long as the circumstances around the market are such as they are, you think that the bull run in gold will continue. So I think that that's, maybe enough to leave it there. It's just going to go higher until something changes.
And also,
maybe let's.
If it's 6,000, that's quite a ways from where we are now. So I can sleep and I'm not fussing around and worrying about this thing very much.
Gotcha. Yeah, and I think that's a wise takeaway for the audience too, is not to worry about targets and lose sleep over them. Let's just end with this question. I know that you're a very prolific writer and economist, and you've got a huge following on Twitter. Where can we send people to find more of you and your work online?
Well, I think Twitter actually is the best place, and that's just at Steve_Hanke. Now, John, if somebody wants me to put them on my weekly distribution list, they can just send me an email at hanke@jhu.edu. I'll add them to my list if they want to get. And the weekly thing, I include things like our interview, for example. When that comes out, I'll include that on my weekly thing. Or if I write some op-ed in Fortune magazine where I'm a contributor, I include that. And or if somebody's interviewing me in the Financial Times or Wall Street Journal or something, I include those things.
Great.
So if they want more, you write me and ask. If they just want to be following on a real-time basis, at Steve_Hanke on Twitter
Fantastic.
or X.
Thanks for that. And we'll make sure to leave some links for our audience in the show notes of this episode. Professor Hanke, thanks for joining us today. I learned a lot. I hope our audience did too. And I hope we can have you back on again soon.
Great to be with you, John. Have a great day.
Thank you so much. And thank you all for joining us on this episode of Milk Road Macro. Until next time, stay safe, stay bullish, and we'll see you all in the next episode of Milk Road Macro. Thanks for joining us. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.